I hope all of you can see my screen. And I think a few more people joined, or I saw little pop-ups. So very welcome to all of you that joined us now. So as I mentioned before, we're going to cover another white paper from AQR Capital Management. This is sort of the same theme as last week. So it's an introductory type of paper, which is also quite nice. It's nice to cover the basics as well. So the title of this paper is Time to Diversify, but into what? So this paper, interestingly, was written in 2021. So the idea is to see what they sort of propose, because they think that, diversifying out of equities is the way to go, and moving towards liquid alternatives was sort of the best option in 2021. And then obviously in 2022, we saw tech stocks crash, right? So it's interesting to see publications after that. So after 2022, did they kind of predict what was going to happen? So that's the idea for today. So in terms of the contents, I'm just going to break it down into the subsections that they have in the paper. So the first one is living on borrowed returns from the future. So that's kind of what they call it, which is quite interesting and cool. And then they sort of say that, we can't really expect to see a repeat of the 2010s in the 2020s, right? Which kind of makes sense. Then they also talk about how much equity risk do you actually have in a traditional portfolio, and how can you diversify away from that? So what can investors do? And then they also go into a few liquid alternatives that they would sort of. And then lastly, I took an article that they posted after 2022 to sort of see if it aligns with what they predicted in this white paper. Okay, cool. So that's the idea for today. So the first thing that they start with is the fact that we are living on borrowed returns from the future. So you will see in Exhibit 1, they look at the average yield-based expected real return. And all of this is based obviously on US data. And they look at a traditional 60-40 stock bond portfolio. So they mentioned that in the 20th century, right, we saw an average of 5% more or less, right? But in the last 30 years, we actually see an average of 2%. And then from 2020 up until 2021, we see an even larger drop, which is very interesting. So yes, the idea here is to sort of diversify away from equity risk. And we can say that from 2020 onwards, what we saw was, stock market valuations were actually near an all-time high. Bond yields were the exact opposite, so near an all-time low. And what they were kind of saying is, okay, some prospective returns look kind of big. So it doesn't look great. So what can we do? And something they also mentioned was, the crash, right, that we saw in March 2020 from the pandemic. So that was kind of fleeting, but it doesn't necessarily mean that what we're going to see in the future, it will be a fast recovery, right? So that's basically what Exhibit 1 is telling us. So we have low expected returns, which will eventually materialize, whether it's in a slow pain or a fast pain. And we saw that it was kind of a fast pain scenario in 2020. So the next reading is basically just saying, whatever we saw in the 2010s, we expect to see that in the 2020s. And the author's basically saying, so we saw in the 2010s stable inflation overall, right? So equities and bonds in your traditional portfolios were actually unusually good diversifiers to one another. And we also saw unusually high excess returns, right? So, but unfortunately, in 2020, after the pandemic, we weren't that sure, right, about the medium-term inflation outlook. And that's why we have Exhibit 2 here on the right, where the authors look at assets and the correlations to the inflation metric. And again, this is from 1972 up until 2021. So what's interesting here is that, for rising inflation, right, the chances of, another decade of sort of low stable inflation is, it's fallen, right? So we should kind of expect that. And if we see this, then it will definitely be a headwind for both equities and bonds, right? So, and that's what we can see here in the first two bars in this graph. So these falling inflation versus things like gold. Okay, so, and unfortunately, because of this and these prospects, it will definitely reduce the diversification benefit. So that negative correlation between stocks. The authors do mention a few popular alternatives. So they mention inflation-linked bonds, real estate, and also long-only assets. So the long-only assets, so they mention that only commodities like rising inflation, which you see over here in two. And then they mentioned that real estate, even though it is sort of more resilient than stocks and bonds, right, to market fluctuations, it definitely underperforms when inflation is rising. And then the last one they mentioned is inflation-linked bonds. And again, even though it like hedges against inflation-linked liabilities, you know, we still see that negative real yields. So this is also a difficult one. Same with commodities. Okay. So they mentioned that, you know, most traditional portfolios have that downside inflation bias. So this was great in the 2010s, but it's definitely not going to be, well, it could be a big vulnerability actually in the 2020s, which is kind of what the authors were saying when they said that we should kind of diversify over the past. Okay, cool. So the next question they ask is, well, okay, how much equity risk do we have? So in Exhibit 3, we see that if we look at sort of a traditional type of portfolio, we can say that, cool, we have our different asset allocations and how much do each of these asset allocations like sort of translate to the overall risk of the portfolio. So we can see here that if we look at equities specifically, right, so there are 4 in total, then I think from privates to domestic, we can see that 55%, right, is allocated to equity, but it actually translates 87% of the overall risk in the portfolio. Right. So yeah, it tends to be dominated by equities. That's what we see in traditional portfolios. And we're going to have a look at private equity in the next slide. But they just mentioned that, you know, even though it's sometimes popular to go into these sort of private illiquid type of assets and equity, it only actually adds to the already dominant risk. Okay. So they also mentioned that equity crashes in general, let's say, for example, the one now in 2020, so the pandemic crash. So even though this one was very short-lived, right, thanks to central bank action, you know, not all bear markets are actually limited to, let's say, for example, a 20% drop, which is what we saw in March 2020. So they mentioned that, well, we actually saw 3 different drawdowns, right, exceeding 40% in the last half a century, and even worse in the half century before that. So yes, definitely something to sort of think about. So what can investors actually do? Right. So they mentioned 3 different sort of topics, and then they give us more information on illiquid private assets as well. So the first thing they mentioned is that, well, okay, if you're an investor that can handle, you have high tolerance for losses, you have constraints on leverage, and you are also seeking high return, right? Then it might be okay to take on equity risk. Okay, so that is one option, but obviously, like, you have to be very for high valuations and inflation risks. And I guess this is definitely something to relate back to 2022 when we had the tech stock, so high valuations. Then the next thing they mentioned, and we also briefly spoke about this last week, as also the option-based protection. So yes, it's great because it insures against that, you know, large drawdowns that you might see in the market, but it's definitely costly, especially over long periods of time. So we know that when compared to trend following, right, the option-based tail protection is definitely great for short, sharp crashes in the market, but it's not great. It does not offer great protection in terms of sustained business. So yes, that's unfortunately going to go back to this one. And then the last one is to raise allocations to illiquid private assets, right? And as we know, like for illiquid private assets, obviously you might pay premium. But what investors sort of hope for in terms of attractive returns is some potential for alpha, right? And then also, yes, the premium. And the hope is that this will offer representation. So the authors actually touched on another paper that was written in 2022. So, sorry, 2020. And this is from Manin. They basically sort of disprove all of the benefits of all 3 of these advantages or all 3 of these options. And they basically say that the benefits are sort of overstated, which is quite interesting. So yes, you guys are welcome to go and read up on that. But in the actual paper, they only go into private assets. So they explain that yes, private assets, it's definitely good in order, it can definitely complement other investments in the diversified portfolio, but by itself, it might not be sufficient enough to provide your desired level of diversification. And then they sort of tell us why as well. These three different disadvantages. So they say that, okay, well, it doesn't actually offer fundamentally different risks. So even though if you compare private to public, it's still the same risk. So even though it's not market to market, your private credit is still exposed to credit risks. Same with private versus public equity. So all of these familiar risks seen in public markets, you will also see. So that's just something to consider. And then they also mentioned slow beta, especially in prolonged bear markets. So here we have large economic exposures, right? And obviously the performance tends to be highly correlated with whatever you see in the market, especially drawdowns. And then here they just mentioned that the slow beta slow beta reduces the diversification benefits that we see in portfolio with private assets. Right. So another another drawback, and then for smoothing up returns. Yes, this is like the main benefit of dealing with private assets is that, because one sell it easily, we can see that for any like short fluctuations, it's sort of protected against that. But the problem is you have prolonged right. So and again, they mentioned that this smoothing effect, although it's great in the short term, it does offset any potential illiquid premium, right? So that also makes it less attractive. Again, as a standalone type of strategy, right? So very interesting. The authors don't go into the other two alternatives mentioned, but what they do go into is what they believe should be implemented from 2021 onwards, right? When this paper was written. So they believe that you should diversify into more liquid alternatives. So the idea behind liquid alternatives is you should get positive long-term returns, obviously, without that passive markets exposure. So that's kind of the idea. And then the authors say, well, okay, cool. What should basically happen is it should have exposure to well-documented premium like quality, momentum, value. And then they also mention a combination of your proprietary signals, as we know this, and then portfolio construction techniques. So they don't go into too much detail with this, but I think what they're trying to say here is that, okay, cool, proprietary signals, I guess you get that from like your alternative data set, right? We do feature extraction, get the signal. Obviously, together with that signal, you still have a lot of noise. So when you're constructing the portfolio, like understanding how to remove the noise, I think that's what they mean in this case. So in Exhibit 4, they mention a few. So risk parity is one, long-short equity, obviously trend following and macro strategies. They also mention corporate arbitrage, and then multi-assets, alternative risk. Yeah. So these are the main ones. And then they also give, I think, short explanations of each of these in the appendix as well. So the idea is that all of these should kind of give broader, or should be allocated across broader assets class range, right? And then also investment instruments. So for risk parity, for example, we can see here it should provide better macroeconomic diversification over your traditional portfolios. Then with long short-term equity, I guess the main benefit here is the beta. We know that with trend following, we discussed this last week as well. So here, because you are following the trend, you can sort of move into that defense position, right, during markets. Okay. And then for corporate arbitrage strategies, so on the Hassan and Team's channel, there's a whole playlist on arbitrage strategies. All of it is free. Like it's quite nice, explaining like all of the different strategies that you get for this algorithms. And as I mentioned, like all of it is free. And arbitrage lab from Hassan and Team's is also, I think, 85% off. So if you guys want to know, try that out. But yeah, so they also mentioned arbitrage. And then the last one is the multi-asset alternative risk premium. So here, things like value and carry things. And again, the main benefits is the fact that so so this is sort of what they would recommend. And then the main idea for this recommendation is, well, okay, can we find sources of return that are currently underrepresented or just altogether absent from portfolios, right? So, and then the idea is to seek returns that are sort of independent from your stocks and the bond markets and your traditional portfolios. And then this will kind of pick up the moment your traditional assets sort of struggle. So that's kind of the idea. But then the authors do mention that, unfortunately, so some of these liquid alternatives have done well in the last years and some have really disappointed. So they mentioned that equity value strategies have suffered since 2018. They mentioned that growth stocks actually outperformed, so that's good. But then in terms of managed futures, so it was kind of underwhelming in the 2010s, right? Which might mean that we can find quite low 2020s. And the reason for this is okay, we saw strong returns during the financial crisis, but then obviously as central banks to curtail the market trends, it was kind of underwhelming. Okay, so even though this is true, right? So some well and others really, the authors still say that, well, okay, it's definitely based on decades of empirical evidence and also a institution. So all of that is okay. And then lastly, they here in Exhibit 5 sort of break it down into what all these levels that are useful and how they're going to what's it going to look like from 2021 onwards. So the idea is that you can take long and short positions, so that you can sort of hedge against inflation, but then also sort of mitigate against low yields, right? Unexpected returns. So they mentioned some strategies, and the first one is equity value, right? And they mentioned that this could be, particularly good from 2021 onwards. So in Exhibit 5A, they actually give us the value spread for some hypothetical value portfolio where extreme spreads have historically preceded strong value movement. So we can see that from you. But yes, we know that equity value is sensitive to changes. So it could provide stability to equity value. And then they talk about trend following here. So that'll be Exhibit 5. So we sort of touched on this last week as well, tail risk hedging paper, but they just mentioned that this will definitely work if in the next decade we see greater macro activate might okay, yeah, we can kind of see that here as well. So as inflation increases. So this is trade return. And then also 12-month inflation prices. Okay. So yes, this is quite interesting to see. And then, as I mentioned, I sourced an article from AQR that was written after the tech stock crash in 2022 to kind of see whether what they predicted worked or not. And it was so interesting to see. So they actually, so this is a graph from that article. So here's the link to that article. It's so interesting. But you guys will see here, so after 2021, we did see a drop, right? We did see a crash. And when you compare traditional 60-40 portfolio with what they were kind of suggesting, so stock bonds and liquid alternatives, right, over here, we can see that the drawdown was definitely less for the portfolio with liquid alternatives. So minus 9.3% versus 11.3% traditional. So very, very interesting. And then same with the risk here as well. So we can see return was 6.8% and the portfolio with so yeah, very interesting. And then I just mentioned here, so obviously that wasn't the only thing that we saw in 2022. So obviously we also saw the war in Ukraine, right? So I'm sure that also contributed to it. I just mentioned the tech stock crash is like one type of event. But yes, we did see like more than 30% as that drop. 2022, and then in this recent article, they also mentioned that assets that heavily rely on capital markets are unlikely to deliver what investors expect. That's the one thing. And returns still, or prospects for returns still remain low, right? So that's another one. And then inflation risk is still, so they mentioned it before, the original paper and then the more recent article they mentioned again. So inflation risk, as we know, the diversification benefits decrease, is that investors should do basically. But it's cool to see that what they did over here, like actually, sort of what they predicted actually. Yes. So very interesting to see. Right. So I'll continue some recording and then if you guys have any questions.